A very warm welcome to the Risk Reversal Podcast. I'm Guy Adami. As you can see, I am joined by the great Danny Moses, sporting his CME Group t-shirt. This is a treat. How are you, Danny?
I'm good, Guy. Nice to see you.
It is wonderful to see you. We have a lot of things to tease, and we will get to that. But Danny, since I know you are a classic rock fan like myself, I don't have any Bon Jovi on my 900 song Spotify playlist, but I am
Me
familiar
neither.
with the artist. Neither do you. But there was an album that came out, I believe it was called A Slippery When Wet. I think it was sort of 1986-ish. You familiar with that?
Great year. Yep.
It was a great year. One of the songs on that album was Wanted, Dead or Alive. It's
Yep.
all the same, Danny, only the names have changed. And if
Right.
you think about it, it is all the same. And the only thing that has changed are the names. And in this case, it's the names we're talking about in the stock market. Because what we're seeing in terms of this vendor financing and the circular nature of everything that we've been reading about is eerily reminiscent of what we saw, 25, 26 years ago. Again, the names have changed, but and what else has changed is the magnitude, the size of these companies, but not all else has changed. So let's start there.
I've seen a million stocks and I shorted them all. So there is a circular nature that I've been talking about on the Tape podcast. You guys have been talking about, and kind of this circular thing that's going on. Call it vendor financing, call it whatever. But when you take a step back to try to do the math on what these companies need to earn, what they need to spend, what their revenues need to be to justify it, the math just isn't going to work. No one cares right now. You buy now, you ask questions later. But there are a lot of similarities. And if you remember, the big thing was, quote, the internet, right? In 1999, 2000. Well, the big thing is now AI. There's no question that those are two real things that are here to stay and are going to flourish. The question is, does the math work? And as I've said many times before, the amount of fiber that was being calculated to go around the earth dozens and dozens of times back in 99 and 2000, everyone wanted a piece of it, whether you're web hosting, whether you were an optic fiber manufacturer, whether you were the infrastructure player. It's very, very similar. And so everyone wants a seat at the table, but there's not enough food, Guy, to feed everybody is the bottom line. So again, we'll see how it plays out.
So let's drill down a little bit on that, because I think it's important. There have been more than a few people and more than a few institutions over the last few months that have come out with pieces speaking to exactly what you're talking about. The math doesn't work. And it was MIT. I saw Roger McNamee recently. He had, I think, an op-ed in the Financial Times. Goldman Sachs had a piece out. Jamie Dimon, I think, recently was talking about this. So there have been a laundry list of people that are having or showing or venting their concerns. My question to you is, what do you think derails this? And this is where I'm going with it. It's clear that the CapEx is there. I mean, people have talked about that. But I guess my question to you is, what's the sanctity of the CapEx? In other words, can you see a situation where all this promised CapEx doesn't come to fruition? And under what circumstance do you think that might happen?
I mean, you'll probably start to find out when OpenAI tries to start charging customers a certain rate, or the services that are being offered, and or are things redundant from a technology perspective, or the product's really all the same. It could be a private company that's currently being funded. We'll talk about PE in a minute, I'm sure, that can no longer get the funding. I think the patience, it will run thin over time if companies don't start making money as a result of all of this CapEx. So I had a friend of mine who showed me a prospectus yesterday. He's a retail investor. And again, this all goes with, oh, great, retail investors getting access to private credit and deals. He was shown some data center deal, 2% fees a year, all this stuff, lock up 7 years. And I said to him, I go, do you think that's positive selection or negative selection? And so I guess, Guy, it really becomes, when are you going to run out of people to kind of sell this stuff to fund it? And when you do that, the music stops, then you start to see. But I don't know, sometimes stocks fulfill themselves. When stocks start to move to the downside, people want to know why and what the story is. And you start to say, oh, well, that was obvious. This math doesn't work. So I think to answer your question, as dumb as it sounds or as simple as it sounds, it's almost a wealth effect, kind of a re-underwriting when stocks start to trade off. And we're going to get that at some point, Guy.
No, I agree with that. And we're speaking today, Thursday. This is obviously, you're listening to this on a Friday, but on a day where one of the analysts out there, I think, put a $300 price target on NVIDIA, which, listen, it may come to fruition, but you wonder what revenues have to be generated to justify what will at that point be, close to a $6 trillion company, I guess, at that price point. But that's neither here nor there. And we've talked about this a while. And I think the point you make is an excellent one, as you typically do. On the way up, nobody necessarily cares the reasons why, but as things go down, people are then looking for reasons, and those reasons that have been out there the entire time become painfully obvious. But the question is, as you brought up, like, what's the catalyst for that? And I think there are a couple of them, just my opinion. I think one of the catalysts at some point is just going to be the valuations, which, at a certain point don't make any sense. And some of the things that we've talked about, the cyclically adjusted price to earnings ratio, which is at, I think, the second highest reading in history. And history is a long time. That Buffett indicator that we talk about all the time, which has been flashing red now, literally for the last 9 to 12 months. At some point, people start to look at those things. But I also think the one thing that has to be, or not taken lightly, is the fact that you might see a slowdown in the economy and an unemployment rate that starts to move higher. And I think that's when the whole CapEx cycle grinds to a bit of a halt. Thoughts on that as a catalyst?
I think we have a K-shaped economy, and that's true pretty much for the stock market as well in terms of the wealth effect. And I think, the wealthier people that are in the markets that are impacted by it. So there's an argument to be made that unemployment will actually serves some of these stocks, meaning, lower labor costs, higher efficiencies, better margins. So you really have to kind of separate those two. There is a point, though, Guy, just in terms of consumer demand, and this economy is certainly always be driven by the consumer. I mean, over 2/3 of the economy is driven by it. At some point, that just has knock-on effects, to your point. I just feel like this is kind of a siloed space. You kind of have to separate that a little bit. But you are already seeing economically sensitive companies start to suffer a little bit for whatever reason, whether
it's definitely 2 or 3 standard deviations away, but it doesn't mean, and I don't think you're saying this, but it doesn't mean it's any less relevant, because when you think of all these huge companies with the spend that they're making, I mean, a lot of these companies are relying upon the consumer in one way, shape, or form. And, at some point it will come back to them, one would think, but, we'll see. We're obviously sitting here on a day where the S&P 500, at least earlier in the day, made a new all-time high. You mentioned,
let me just say one thing on that, because I think you bring up a really good point. There's enterprise spending and there's spending by the consumer, right? And I'm really segregating it by those two things. You're 100% right. I don't care if you're bringing AI into your corporation to make things more efficient. If you have a product that's selling to the end user as the consumer, at some point it rears its head. So I agree with you. I just wanted to.
No, that's fair. I think, listen, it's all, and again, you wonder at what point, where in the timeline do we get there? I mean, we're not seemingly close to it yet, but I do think it's out there. This sort of Damocles has been hanging above this market for quite some time. Now, you mentioned private equity and some private credit stuff, and more people seem to be writing about that. And, we'll talk about Jefferies anecdotally, but I mean, there are things, again, going on that most people are not focused on because, they're not publicly traded companies. So why worry? But, I think they're concerning.
Yeah, and there are some publicly traded companies, obviously, within
some of them, without that. Carlyle.
So when you look at a Blue Owl or something that's down 30-40% from its highs, when you look at the Invesco ETF, I think it's PSP, it's not down a ton, but it's down 15% off its highs. These things don't act great. What has been the big driver of liquidity in this market has been private credit. It's the be-all, end-all. You don't have to worry about it because it's not in the banking system. They just replaced the banks and now they're lending. Well, we know the lending standards aren't up to par, or at least wasn't what the banks used to do from a covenant perspective, coverage perspective, all the things you would look and see. So we're now starting to see, some more economically sensitive things, or things that are impacted by tariffs, whether it's an auto part company or a healthcare company or whatever it might be. We're starting to see bankruptcies start to occur in size. And when was the last time we even were concerned or saw something that came out of UBS, Jefferies? We've seen this game before, Guy. When we started this podcast in 2021, there was some stuff going on with Credit Suisse. It ended up taking them down on some same type thing, factor lending, all that stuff. So it's just a reminder that that no matter how good, whatever you're lending to, it still has to operate well. And you're starting to see it. And I remember, people always say, oh, would you compare this time period to 99, 2000? Or would you compare it to kind of 2006, 7, 8? And I always say it's a little bit of everything. This, unlike your first question about AI, which compares more to 99, 2000, this reminds me of 06, 07, 08. Why? the big leaders were the banks and the mortgage companies. Those stocks started to suffer before the rest of the market did. And those were the engines of everything, were the lending vehicles. And so you have to start to take, at least you have to acknowledge what's happening there. And there was days, Guy, where we're running the equity fund, but I would talk to the fixed income guys first about our credit default swaps and positions, because that to me was the leading indicator. So we are seeing a widening right now. And I think, Guy, the belief is that because the Fed's going to be the savior and they're cutting rates, that it'll all be fine. That doesn't fix bad underwriting. It just doesn't. So it's certainly worth watching.
No, I agree. And listen, you mentioned Jeffries, and again, I don't want to pin the market on the back of Jeffries. I mean, it's probably an $11 billion company, so it pales in comparison to some of its rivals like Goldman Sachs and Morgan Stanley. Throw a JP Morgan in there just in terms of size. However, don't diminish what's going on here. And as you said, I mean, Jeffries, I guess they have Leucadia Asset Management Fund within Jeffries, which owns about $715 million of receivables from auto parts maker First Brands Group, which filed for bankruptcy. So Jeffries, obviously, the stock has not been trading particularly well. By the way, First Brands, who filed for bankruptcy last month, I think they have more than $10 billion with the B dollars in liabilities. And they say, okay, it's not a huge number. No, it's in the scope of things. It's not a huge number. But if you think this is the first and last, think again. I mean, to me, this is sort of an opening salvo of what's probably out there in the ether. So I think I just think it's the first of many. And you sort of addressed that in some of the statements you made a few minutes ago.
Yeah, listen, when you raise this much money in private credit, and let's keep in mind, Jeffries is not your traditional bank, right? So they don't have the same kind of reporting that goes on, and they can take a little bit more risk, and they have been, and they've been very good at what they've been doing. But let's be clear, it's not just going to be First Brands, right? It's what are the lending standards, or how much money was chasing these type of assets? So you're right. Whether we want to call it some type of canary, the coal mine, I don't know. But it is certainly, again, wakes people up to the fact of, hold on a second, what other covenant light loans are out there? What other things should I worry about? And so now you're going to have all these screens being run, and every private credit firm is now saying, okay, guys, we need to separate our portfolios. What's our surveillance department saying? And so questions will now be asked when people start to lose money, Guy. Same way we just talked about the stock market. People start to question valuation once the stock goes down. Same thing's true in the lending market. Like, hold on a second, what are we lending towards, and so forth. So again, it's not a coincidence that private credit and all this is making its way to retail at this exact moment. The institutions were somewhat full. So
it's worth watching. But, one of the things that I think has been sniffing all of this out has been, and again, I want to emphasize, you were early, and usually in our business, early is wrong, but in this case, early was right, pointing out some of the many reasons you like the gold market. And as we're sitting here, gold seemingly makes a new all-time high every day. And I just want to say it's been doing it in ways that historically it hasn't done it. I mean, gold's going up with the dollar up, dollar down, yields up, yields down. Seemingly in every environment, gold just sort of finds its way higher. And that's been in large part predicated on the fact that for the last 4.5 years now, central banks have been buying gold in record amounts. And I think I've said this, and I know you probably agree with me, I think central banks were sort of hedging their ineptitude, and they were sort of hedging against what they viewed to be the inevitable. Here we are, though, Danny. Gold has been flashing red in terms of the warning signs for quite some time. Is that something we should be paying closer attention to?
Yeah, for sure. And you've been talking about gold as long as I've known you as well. So I think we view it similarly. A couple of things to note. Peter Bookvar, had a great note out about China reserves, and Luke Roman has also pointed that out, that, if you look at the amount of U.S. treasuries that China has let roll off from near $1 trillion to around $700 billion, it's not a coincidence that they've basically bought about $300 billion in gold here in the last few years. Russia avoiding economic sanctions by buying more gold as part of their FX reserves and so forth. And the most interesting point I saw was that if gold reaches $5,500 an ounce, it will surpass the U.S. dollar as the world's reserve currency.
Think about that.
So it's feeding on itself now. Now, when you see certain pundits in the news, like a Jim Cramer, and jump on the train a little late, you should get concerned that you might have a little bit of a sell-off because it's now reached that retail frenzy. That being said, it hasn't gone up from retail. I don't think retail is going to be the driver of it going forward. It's been, to your point, central bank demand. And basically, as you've said, I don't want to quote you, I think hedging their own ineptitudes or something like that of these central banks, that's what they're doing. And gold is proving to be the better currency, at least it has been. And again, when people look at their total return, whether it's in Japan or in the US markets, in dollar terms, you got to start to look and see, okay, how's my return doing just on a absolute basis, and then on a relative basis? Dollar's down what? I mean, it's come back a little bit here, but down 16, 17% off its highs. Yes, the market. So again, you got to factor this stuff in, and it is meaningful, Guy, because it's been around long before the US dollar, and it'll be here long after the US
Yeah,
dollar.
listen, I agree with you. And, this is the worst year for the US dollar. Now, with that said, over the last couple months, the dollar has stabilized. I want to be clear. It has not been down in a straight line. However, it's the worst year for the US dollar in performance terms in the last 50 years. Now, I think that's part of the gold story. I don't think that's nearly the entirety of it. I do think it's a central bank thing. But then I'll ask you the following question. At what point does this weakening dollar start to matter? Because I do think part of the policy, whether acknowledged or not from this administration, is they are trying to weaken the dollar because you're not going to grow your way out of a $39 trillion debt problem. You're going to devalue your currency. And there's this whole debasement trade that's been going on. By the way, it's seemingly been supportive of equities, but my question to you is, when is it not?
Yeah, I guess you got to look at it really versus the yen. You got to look at it versus the euro, which are two of the bigger baskets, obviously, that are out there. So I do think you need to look at it. And overall, though, certainly it's good for risk assets to a degree. But to your point, when you have debt like we do on the balance sheet, there are no more rules. Nothing really works like it should. It's not, it's not a playbook, so to speak. So I think it's more signaling anything. I think what it's really signaling is the fact that people are losing faith in not just the US dollar and all fiat currencies, expressing it in gold and crypto, by the way. And it does, to your point, have real impact in terms of swaps and trades and all these assets, dollar-based assets that are out there. So there are ramifications, import, export, all these things. So there's a functioning part of it and a symbolic part of it, right? You got to kind of group it all together. But the one thing has been, Guy, I think the trend we are seeing is that people fear where the US dollar is being, is starting to lose its status in the world for whatever reason, politically, whatever you want to say. And what is replacing it? Gold. And that, to me, is the overriding thing here, guys. So without going too much, and listen, the truth is this: if that really happens, as my friend Rob always says, how do you trade the end of the world?
Well,
So let's say
exactly.
gold goes to $6,000, starts to get hit, and we really have a change of a regime. We have much bigger issues than trying to figure out the top in AI stock. So I think we're not there. We're not even close to that yet, Guy, but I think it's more of a philosophical thing that he really can't.
I agree with you. We're a lot closer than we've been. And I know you know this. I mean, so there's clearly something going on. But, again, you're also one of the people that were pointing out some of the incongruities in terms of what was going on in Japan. And it's manifesting itself again. You have JGBs, you have Japanese bond yields continuing to go higher, which historically would mean your currency would strengthen. But that's not what's happening. You have yields going higher in Japan. You have a currency that's been weakening at an alarming pace. As we're sitting here right now, dollar yen is at 153. I don't know if dollar yen has been in this high in terms of weakness of the yen, strength of the dollar. Probably, if I had to guess, since March-ish, and I don't even think it was that high back in March. Now, if you remember, which you do, it was July of last year where dollar yen got up to about 160 and change. It was a Thursday. We had a soft CPI number, and dollar yen proceeded to go from about 161-ish down to about 157 in a straight line, which in currency terms does not happen. It subsequently cascaded lower, crescendoing in September, but taking a breather in August, and we all remember what happened in August of last year. So now we have a yen weakening again with their bonds going down, yields going higher. Something's got to give here, Danny Moses.
Well, that last part is what really matters. So currency is one thing and where the yields are. The Japanese 30-year yield is where it was when they began their QE experiment. They were the first one in 2001 to start this entire thing. So we are at those levels around 3.2%, which on an absolute basis doesn't sound high, but on a relative basis, it is. Their 10-year yields are where? 2007 levels, 1.7%. So you have a weakening yen that could spur on inflation, a new prime minister who obviously is deemed to be dovish. She seemed to be obviously going to, less hawkish, at least is what people thought, so less likely to raise rates. And that's fueling. We saw this happen in the UK a couple years ago, right? All of a sudden you get this moment in time where it's like, okay, you got to save. Now you need to save your currency, pick your poison, whatever it's going to be. But the bond market's telling you that the yen stays sustainably weak. It could be inflationary and feed on itself. You talk about debt to GDP in our country,
Oh
their
no, it's a
debt to
problem.
GDP is almost double what we
Yeah.
are. So again, these are the things from a plumbing perspective why people should pay attention to all those things, because they matter. They don't matter. They don't matter. And then all of a sudden they matter. And people say, I wasn't paying attention. What happened? And all we want to do is not be alarmist, but point things out that people need to be watching.
Well, that's exactly right. I mean, you're trying to point. Listen, not that I was anything special, but I remember a certain football game where we beat a team that we should not have beaten, and everybody was all excited. And that Monday in practice, we watched film and then we practiced, and our coach beat the shit out of us. And I'm saying to myself, my God, we just came off this huge win. What the hell's going on? So years later, I asked him. I said, "Do you remember this?" I said, "We beat Irvington, blah 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 blah." And he said, "Yeah, I remember it," because he said to me, "The best time to have a coaching moment is when things are going well." In other words, you don't beat the shit out of people when you're on your ass. You do it when things are going really well, because things are going really well. So to your point, we understand that things are going well in the market, but the best time to point out a lot of the things that we've talked about for the last 20 minutes are when things are going well, because you don't want to be the person that says, damn it, I wish I had pointed this out when things go pear-shaped. At least you can sleep at night knowing that, hey, we were pointing out a lot of these things long before they mattered. And, none of these are timing indicators, but people should be aware of what's going on, not only here, but around the world.
No, I totally agree with that. And reminds me of the Steven Seagal Out for Justice, seeing anybody see Richie? Anyone nobody see Bobby Lupo? It's like, is anybody watching? Like, what's going on? No, they don't want. This market has been about immediate gratification,
That's right.
right? And short-termism, and that's fine. It's been working. It's fine. But you have seismic stuff occurring here underneath the surface. Gold's telling you something. Currencies are telling you something. Like, yes, I get it. It's AI. It's all this stuff, but it needs to be paid attention to for sure, guy.
Some of the things that you and I have both talked about is this advent of passive investing, which, over the last 5, 6, 7 years has really taken the market by storm and has been a fundamental driver of the market. And we've articulated different reasons why, it's a wonderful thing on the way up. It's very problematic on the way down. Torsten Slok, who I know you're a fan of, actually put pen to paper, and he pointed out sort of the math around all this passive investing and things that we've pointed out. Passive investing does not care about anything that we've talked about for the last 25 minutes, does not care about valuations, does not care about fundamentals. It just finds a home in the form of ETFs and mutual funds that in large part own the stocks that we talk about seemingly on a daily basis, which is one of the reasons valuations get pushed up to the levels that they are. So maybe in this new paradigm of passive investing, you can't look at historic norms and say, this is where we should be trading. The problem, of course, is, and this is what I pointed out, and this is what he pointed out, passive is great on the way up, but when passive becomes active, it's not active going higher. It's active because people are looking for the exit ramps. And, the fact that he's pointing it out now, again, you can't time these things, but I think it's interesting that he's coming around the same types of things that we've been talking about for a while.
Yeah, I mean, passive is here to stay. It's growing. I think you need to separate within ETF world of actively managed ETFs versus passively managed. I think that's kind of a new breed of thing. So at least you have someone actually watching and actively managing that portfolio. But again, just be cognizant of, again, selling or buying in this market that, ETFs on single names, 2x, 3x ETFs on single names, it has a real impact on behavior. And I think the behavior of stocks sometimes influences, well, I know it does, influences the way that people feel about missing out on a trade or chasing. Right. And this. And you are seeing very violent moves up and down at various times in names, and you just should be aware of that. And I think I don't think people pay enough attention to it to a degree. And I always harp on this guy that even the active funds are measured against these passive benchmarks, so to speak. And so higher stock prices sometimes beget higher stock prices, because if this is a $4 trillion company, that you can't afford not to own it. I pointed out in a piece this week about gold. No one cares about gold. The only mining stock that exists in the S&P 500 is Newmont. It's part of the materials sector in the S&P. The total weighting of materials are 1.75%. So if I'm a fund manager in Boston, I don't really care. So it's one thing to not own gold. It's another not to acknowledge why it's doing what it's doing. So again, I think I think eyes wide open here, Guy, in this market.
Yes. And so I'll say to you this, if we're on the precipice of something, and I have no idea, but let's just humor me for a second. What becomes a sector where people look to for value? And I'll start, I think they're going to find it in healthcare, not Eli Lilly healthcare, but, healthcare or pharma ex Eli Lilly. And to a certain extent, they might find it in some of these energy names because, you think around, what's going on in terms of utilities and some of these energy companies and some of these, if you think about what's been going on with the refiners, those stocks actually have been working pretty well. So thoughts on what potentially could work if the baton is passed?
I guess if the reason the baton is passed is more important, if it's because we have a continued potential slowdown in the economy, unemployment rising, things like that, maybe energy prices hold okay. They're already kind of in the low 60s here. Maybe if you told me that, then I would say I'd love energy here as as somewhat of a defensive rotation to hide in. Consumer staples, certainly. Healthcare, yes, you're right, but it's a minefield politically in terms of what you can own and what you can't, especially with the shutdown going on right now. What might be the result of healthcare premium payments, things like that. So, but yeah, you look at utilities. You would think that 10-year yields, if the market had itself, would go down. All things being equal, forget about the debt for a minute. Those make utilities more attractive, on a yield basis. And so, I think dividend-paying companies, I think that the Verizons, the AT&Ts, the things like of the world like that are good places to look. And so, again, you can see what we've seen has been basically low-quality stocks have been leading a lot of this rally. I think you've pointed that out, right? I think Liz has pointed that out. And at some point, that's not a great sign for things because you want quality to start to rise to the top. So
you mentioned yields. Let's talk about that quickly. I think I've been pretty outspoken in my views that yields are going higher. And for a period of time, I look smart. And other periods, I don't look so smart. I mean, I will say that since the Fed cut rates a few weeks ago now, yields have only gone higher. They briefly went lower in the aftermath of that rate cut, but they've been basically trending slightly higher since. And this is a replay of what we saw in September of last year. I think rates go higher for a myriad of different reasons, not least of which bond market is a confidence game, the things we talked about with what's going on in Japan, debt levels that are unsustainable. The flip side of the coin is if things are weakening, yields should go down. So there's definitely this tug of war here around the 4.15, 4.2 level. What are your thoughts here in yields? Is it just, do I make too much of it? I mean, we're just going to be stuck here, or something got to give on the yield front?
no, it's a really big deal. And I think even more so now. I think if you had asked 6 months ago, what's the big level, what's the breach level, and symbolically, whatever, it's 5%, right? I think now in the 10-year yield, it's actually 4.5%. And the reason I say that is there's a misnomer. It is what it is. People think that the Fed cuts rates for the right reasons. It means that inflation's coming down, or they don't choose to just focus on employment, one other. So I think people will be very discouraged if 10-year yields start to move higher as the Fed is cutting rates, because that doesn't, quote, according to their playbook, doesn't work. We now have defaults occurring in the, we're seeing CLO funds. So I think it's a little more fragile than it was. So we used to say that this economy can sustain a 5% 10-year, right? It has historically, it's been fine. That's fine level. I think that's moving a little bit, guys. So I think to your point, I think it's more of the trend. So why is it shooting up and where's it going? I think you get 4.3, 4.35 right now, and the technicals will come out, it's going to 4. You will have a market that will probably be very volatile on the equity side and sell off. So I would say 4.5 is the new 5. How about that?
And I'll throw this in the mix just to give people something to chew on. We have not talked about HYG for a while, and the reason why, because it really hasn't been a story for a while. I mean, it obviously cascaded lower in April, like everything did, but it found its footing and it traded, I think, north of about 81 or so. Now, with all that said, I'm not suggesting people should trade this thing, but they should watch this thing. And if we are, in fact, rolling over on the credit side, I think it's going to manifest itself in weakness in the HYG. So I just want to sort of throw that out there for the viewers and the listeners to have on their radar screens as well. I want to make a quick pivot because what you've done on the Tape podcast has been amazing. You recently had Michael Lewis on the podcast, which was fascinating. Speak to me about the guests you've had and some of the things you have coming up.
Yeah, so Michael Lewis was actually part of our Substack that we decided to release on the Tape. So Porter-Vini and I, as you know, started the What Are We Doing Substack. So we write stuff during the week. We record another podcast called the Friday Night Dirty, which is for members on that Substack. But Michael Lewis came on for the Substack, but then we put it into the feed. So we've had that. I've had a slew of great guests which have come on in the last few weeks. Meredith Whitney, who obviously Shanali Bassick, which came on. Shayna Sizzle just came on. Luke Roman's going to be coming on. Dennis
Who I
DeBuscher's coming
love.
back. I try to change it up a little bit and get different viewpoints. Have had some people that are very positive on crypto and so forth. But yeah, stay tuned. So, a lot more coming there. And Guy, one of the areas that we've talked about it, I'm sorry about the football season. I'm sorry that the Yankees season is now over.
No, you're not sorry.
We'll skip right by that. Has been these online gambling companies,
Yeah.
which, as you know, we've talked about for years on the podcast. No one was more bullish than me on all the names associated in the regulated sports gambling market. And when I went on Fast Money with you guys back in June, and I just happened to say I'd be concerned about these prediction markets and their impact potentially as we go into football season, I was not laughed at, but I was like, oh, what is, I was just stating the fact that it might have an impact. Well, it's definitely having an impact that Kalshi and Polymarket and Robinhood, who partnered obviously here, we were out at this conference in Las Vegas talking about it. It's now having somewhat of an impact. And it's not massive,
100%.
Guy. It isn't massive, but it's enough that, and our friends at CME partner with FanDuel, it's enough to wake people up and say, maybe this number's a little bit at risk. But I just wanted to stress that it's not the end of the world for these companies. They might be a little bit oversold at this moment, DraftKings, FanDuel, Genius, and so forth. But again, these are the trends. I guess my point is, it doesn't take a lot when you change just slightly numbers in a model, like 2026 EBITDA numbers for FanDuel or DraftKings, tweak it a little bit in a model, stocks sell first and ask questions later. I equate that to everything else in this market, Guy, what we opened with here on AI. If something happens and numbers get adjusted by any of these companies, take it down, it will have an impact on everything. But I wanted to just mention, because I'm getting a lot of questions about
I will say that I never laughed at you, number one.
Yeah.
I actually pay attention to what you said. And you mentioned DraftKings, which recently traded down to the levels that we saw in April-ish. I think we got down to about, $31. I think we got down to about 29.5 in April. So to your point, maybe they're sold enough worth taking a look. You mentioned my Yankees being summarily defeated by the Blue Jays of Toronto. You also mentioned my Giants. But what you didn't mention, and I know you're thinking about this, is the quarterback of the Indianapolis Colts, who 5 weeks into the season-ish is not going to be the MVP of the league, but is definitely in the conversation. So thoughts on one Daniel Jones, Danny Moses?
So I was off by the end of Russell Wilson's tenure for the Giants by 1 week this year. It was the following week. It wasn't Dallas. He actually had a good game. Daniel Jones, I'm not a believer, Guy. I think the coach is really good. I think their schemes are working. We've seen moments again where you see what he does and make some bad choices on the ball downfield. They haven't really played great teams yet, Guy. So I'm not a believer, just not. And I wasn't a believer. I think, by the way, it's clear the Giants obviously misappropriated him, miscoached him and all this stuff. I'll give him that. But we knew that was dysfunctional. But anyway, not a believer. So we'll see.
Well, I also say this. We had a conversation, not that this helps anybody, but the Denver Eagle game, we both said
yes,
Denver in the money line, and that was spot on. Although I will tell you, for a half, it didn't look like it was going to come to fruition. As we reach this week in the NFL and the league where they play for pay, anything you're seeing this weekend that we should talk about?
Oh, there's a value stock out there for sure, and it's the Baltimore Ravens. And it's really interesting when you look at the event markets. They still almost have as good of a chance as the Pittsburgh Steelers to win that division. Okay, because Jackson's going to come back from injury. They're going to go into bye week. They're getting 7.5 points at home this week against the Rams. Rams, West Coast team, 1:00 game, blah, blah, blah. But give me Harbaugh and 7.5 points with Derrick Henry in the backfield. Cooper Rush obviously did not look good last weekend, but I think give him another week in that offense. I think they're going to keep that game close, and the weather is going to be awful.
Atrocious.
Atrocious. So that's of all the games I've seen this year so far, and I'm above 500 on my picks on the tape, this might be the best one I've seen. You're getting Harbaugh and 7.5 points at home against the Ravens or at home against the Rams. So that stands out to me, Guy. I don't know. How do you feel about it?
I knew I could come to you. Had a feeling you were going to go there. The Ravens defense has been just god awful. It's unbelievable. Yeah. Yes, but it's amazing. And you just think, this is a proud franchise, a Harbaugh coach team that I'm hard pressed to believe is going to lay another egg, especially at home in shitty weather. So I like what you did there.
And I would add, they're going into a bye week. So if they're 50-50 on playing guys that might be a little bit injured, I think you play them because you're going to have another week off between. So that's my feel.
The great Danny Moses. By the way, next week, not only will Danny Moses be part of the podcast, Dan Nathan will be there. G Swizzle, yours truly, will be there. Porter Collins will be there. And Vincent Daniel will be there as well. I mean, this is going to be just a fricassee next week.
It'll be a lot of fun. Look forward to hanging with all you guys. So
it's going to be a lot of fun. Danny Moses, you're the man. Check us out on our YouTube page, Risk Reversal Media. Check out the On the Tape podcast. Talk to you folks later.